In my first years of trading, I've blown 2 trading accounts. We're not talking about massive figures here, but this experience can prove to be a good thing if you can learn from it. I personally learned the importance of risk management and position sizing, and I know for a fact that I won't be using several strategies that look good on paper, but in fact they're a sure thing to lose money. Today I'm sharing these strategies so you can avoid making the same mistakes I did. So if you could, like, subscribe to the channel and stick around for the full video. When you're just starting, you're introduced to trading indicators. You learn about the RSI and the stochastic, and you learn about the concept of overbought and oversold. You're told it's time to sell when the RSI reaches the 70 level and to buy when it breaks below 30. And I used this method to enter my trades for a long time, slowly diminishing my account. But there's no such thing as overbought or oversold. As a technician, your primary goal must be to find and ride trends. This is where the concept of overbought can work against you. Once price has moved up for any significant amount of time, there will be many technical indicators that will start to flash the overbought signal. This is very common with bounded oscillators, indicators that have upper and lower value limits. Many technical indicators go up and down frequently. Even if the price is continuing to move higher, they were designed to work that way. In reality, they are meant to be used when a market is moving sideways, not when it's trending. My point is, right now, if you open your trading platform because of a current strong rally, there are lots of markets out there that are in overbought territory. You are told that you shouldn't buy any of those markets, that you should be prepared to sell. This is a bad strategy because your job is to take advantage of a trend. And when the RSI is overbought, it says that the market is in a strong trend that is demanding to be ridden. Instead of chasing overbought or oversold levels, try to focus on increasing momentum. Momentum trading is a strategy that focuses on the strength of price movements. It is based on the idea that if there is enough force behind a price move, it will continue to move in the same direction. When a market reaches a higher price, it doesn't mean it's overbought. On the contrary, it usually attracts more attention from traders, which pushes the market price even higher. Lately, I've seen a growing number of people claiming that the martingale strategy is an ideal system that can guarantee your success in the long run. At first glance, it looks like an intuitive strategy promising potentially high returns. The reality is that martingale systems don't work in trading, period. The martingale strategy is nothing more than a gambling system in which you increase your position size after every loss. You bet on the occurrence of a certain event. If it doesn't occur, the strategy requires you to double your position size until you score a winning trade. Let's say you risk $10 on a trade. If you lose, the next one has a $20 stake. The next trade you risk $40. You continue to double the position size until you get your win. Sounds simple enough, right? You keep on losing, but on the winning trade, you make more than enough money to cover your losses and the net profit. The reality is that the potential risks of the martingale strategy far outweigh the potential rewards. You'll need an infinite amount of capital, which, realistically, isn't something the average trader has access to. You may run out of funds before the market turns in your favor. You'll then be forced to exit the trade with disastrous losses. There's also a potentially huge problem when trading with leverage. Even small price movements against your position can result in heavy losses. In such instances, your entire trading account could be wiped out after 4 or 5 consecutive losses. Also, spending increasing amounts of your trading capital to achieve only a small profit doesn't make much sense. Not to mention that your trading platform may place limits on how many times you can place a trade, as well as the trade size. This means you don't have an unlimited number of chances to double your position. From the perspective of risk and money management, which are essential for long-term success in trading, the martingale strategy is by no means recommendable, and you should avoid it at all costs. When you're first introduced to trading, moving averages are presented as the ideal indicator, and there are many ways of using moving averages to trade, but by far, the most common method is to trade when the short-term moving average crosses over a longer-term moving average. For example, if the 10-period moving average crosses above the 50-period moving average, you typically assume that you have a new buy signal. Let's stop for a minute and think about what exactly is occurring at the point of a crossover. When the 10-period moving average and the 50-period moving average are at the same price, the trend is not nearly as clear as it should be. What you are really observing at the crossover point is that the average of the last 50 prices is exactly the same as the average of the last 10 prices. If you are looking for trends to trade, this equal relationship of the two moving averages is not a reliable or logical indication of a trend. In an uptrend, the average prices over the last 10 days should be much higher than the average of the last 50 days. By taking a trade at the crossover point, you are limiting your trading. For best results in a trend-following system, you want to be trading when the trend is clear and reliable, not when the trend is confused and questionable. I lost a lot of money trying to find a perfect combination for a moving average crossover that will work on all market conditions, especially during choppy periods. Yes, crossovers work in trending markets when price swings are large. In a sideways market, they will destroy your account. Instead of trading at crossovers, you should trade when the moving averages are parallel, or when the short-term moving average is moving farther away from the longer-term moving average. To identify the most reliable trends, you want to see the slopes of various moving averages all moving steadily in the same direction and not crossing back and forth. If you take a look at any market with a strong trend, you'll see that the moving averages are not crossing back and forth repeatedly. They will be moving in the same general direction in a more or less parallel fashion. Now look at the chart of a non-trending market. The moving averages will be crossing back and forth very often. If you are trading crossovers, you will be trading more often in a non-trending market and trade less in strongly trending markets. Is that what you want? No, obviously. You want just the opposite. You want frequent entry opportunities in trending markets, and you want to avoid as many trades as possible in non-trending markets. With a little backtest, I'm sure you can design some reliable entry signals that are based on moving averages, but avoid the typical crossover signals. After I blown my first account, I started researching more and more about risk and money management, and I discovered grid systems. A grid trading strategy is a method of adding trades as the market is going against you or in your favor. Grid trading is when you place orders above and below a set price, creating a grid of orders at incrementally increasing and decreasing prices. In theory, it is adding to your winning positions and fixing your losing ones. For example, a forex trader could put buy orders every 20 pips above a set price, while also putting sell orders every 20 pips below that price. This takes advantage of trends. You could also place buy orders below a set price and sell orders above it. This takes advantage of ranging conditions. As good as this setup sounds in theory, it has a significant trap built into it. The main problem with a grid system is that it takes you away from the responsibility of having a proper trade management plan. The trap basically means that if you tend to grid your positions, you are actually in a state where you're denying taking losses. This, on its own, is a very big warning sign in your trading plan. If you don't realize that you should be taking some losses, And if you don't accept that losses are part of the game and need to be cut short, not eliminated, this is a problem that can quickly turn into total destruction of your trading capital. Greed trading is a textbook example of a martingale trading strategy. This means that a strategy increases risk and leverage with increasing losses. Modern position sizing and money management techniques usually work exactly in the opposite way, namely to decrease the risk after losses and increase the risk after profits. In reality, it's very hard to use a grid system without destroying your account. In a grid system, it's very hard to avoid taking an extra grid or an extra entry if the market doesn't go in your way. The system will fail when you get into a very directional market that runs against you. The system needs pullbacks in order to average losses. Otherwise, you will find yourself adding to your losses and making them bigger. I tried to implement a grid strategy a long time ago, and I was very lucky not to blow my entire account in less than 1 week. Please avoid any grid trading systems. It takes only one trading mistake to tumble your account into a severe loss, destroying weeks or even months of profits. "15 years ago, when I started trading, I used to trade all major news releases. And let me tell you, news trading used to be profitable. I just placed 2 pending orders 30 seconds before the event, 10 pips above and below the current price, and then I just waited until the order was triggered. At that time, there was a period when news trading, or better said, news scalping, was actually working. Not anymore. Maybe I was lucky with my broker, but there weren't so many spikes, slippages, or spread increases. But nowadays, it's very hard to make money trading news. In hindsight, news spikes look very obvious, but in the heat of the moment, and the moments leading up to the news, it can be very hectic and even confusing at times. With a variable spread broker, the problem with news trading is that when markets get volatile, the spread can increase exponentially. This can cause your trade to be immediately negative, even if you technically receive a good price on your entry. Slippage is another major problem when scalping news. Slippage occurs when you make a trade, but you get a different price from what you expected on an entry or exit from a trade. Around major news events, getting in and out at the price you want will prove difficult, not to mention the multiple spikes up and down before and after the news release. Price reacts to news in many different ways. You can often see that price will drop significantly after a good news release, or it shoots up when the news are bad. It's very hard to trade in the first minutes of a major news release. If you want to take a trade, you may not get in soon enough into a profitable position, and you'll end up chasing price. Nowadays, I never trade during the first 5 minutes of a news release. Instead of trading what I think will happen or should happen when I see the numbers, I'm trading what actually happened after the initial movement. I analyze the resulting price action after the news release. It's a more conservative approach, but you'll protect your account from the fast and volatile movements. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.